Let's get right to it. Stock indexes might sound complicated, but they're actually a simple way to understand what's happening in the world of investing in the economy. You hear names like the Dow Jones, S&P 500, and Nasdaq all the time. But what are they, and why do they matter to you? Think of them as a report card for the stock market, grading groups of America's biggest companies. They give you a snapshot of how well or how poorly the market is doing at any given moment. The Dow tracks 30 giants, household names like Apple, Coca-Cola, and Boeing. It's one of the oldest and most watched indexes in the world. The S&P 500 covers 500 major companies, representing a broad slice of the American economy, from tech to healthcare to retail. The Nasdaq is packed with tech innovators. Think Google, Amazon, and Tesla, making it a barometer for the technology sector and growth companies. These indexes aren't just numbers, they're indicators of economic health. When they move, they reflect the confidence, fears, and hopes of millions of investors. Why should you care? Because your retirement accounts, like 401(k)s and IRAs, are likely invested in these very companies, either directly or through mutual funds and ETFs. When indexes rise, your savings can grow. That means more money for your future goals, whether it's buying a home, sending kids to college, or enjoying retirement. When they fall, your nest egg can shrink. That's why even small changes in these indexes can have a real impact on your financial well-being. Paying attention isn't just for Wall Street pros, it's about being smart with your money. Understanding indexes helps you make informed choices, not just with investments, but with everyday financial decisions. The performance of these indexes tells a story about the economy we all live in. When markets are strong, it often signals growth and opportunity. A rising market often means businesses are hiring, giving raises, and innovating. It can boost consumer confidence and create a positive ripple effect throughout society. Even if you don't invest, the market's direction can impact your job, the prices you pay at the store, and your overall cost of living. Your financial life is connected to Wall Street, whether you realize it or not. The ups and downs of the market can affect everything from your paycheck to your mortgage rate. Knowing if the market is strong or weak helps you make smarter decisions about saving, spending, and even your career. It's a tool for planning, not just for investing. So next time you hear the S&P 500 hit a record, remember, it could be good news for you too. It's a sign that the economy, and possibly your own finances, are on the upswing. It's about being financially aware and in control. The more you know, the better prepared you are for whatever comes next. That's why stock indexes matter, and why you should care about what they're telling you. This week, the stock market rallied, meaning prices shot up across the board, creating a wave of optimism among investors. The Dow Jones climbed over 1%, a significant gain that caught the attention of market watchers. The S&P 500 rose 1.2%, continuing its upward trajectory and reinforcing investor confidence, and the Nasdaq soared 2.2%, leading the charge with tech stocks performing exceptionally well. Both the S&P 500 and Nasdaq closed at record highs for the third straight week, a remarkable achievement. That's momentum. Investors are feeling optimistic, and this sentiment is driving further gains. On Friday, the S&P 500 closed at 6,664.36, marking a new milestone, and the Nasdaq at 22,631.48, their highest ever, reflecting strong performance in the tech sector. For anyone with a retirement account, this rally could mean hundreds or thousands added to your balance, a welcome boost. Nearly 28 billion shares traded on Friday, showing huge interest and confidence from investors across the board. High trading volume plus rising prices signals a strong market, indicating robust economic activity. These gains reflect renewed faith in the economy's direction, suggesting a positive outlook for the future. While 1 week doesn't guarantee the future, it's a powerful positive signal that can't be ignored. Wall Street's Banner Week isn't just for people in suits. It's about growing value in the businesses that power our country, from tech startups to manufacturing giants. The financial report card for corporate America is coming back with straight A's, a testament to strong performance. And that's something we all need to pay attention to, as it impacts everyone from individual investors to families planning their financial futures. Indexes are made up of companies, and every week, a few of those companies can make a big difference in how the market moves. This week, Two familiar names took center stage and became the driving force behind the numbers. Apple and FedEx did the heavy lifting, pushing the market higher and capturing the attention of investors everywhere. Apple's stock jumped 3.2% after JP Morgan raised its price target, signaling that Wall Street believes Apple's future is even brighter than before. The excitement around the new iPhone launch created a buzz, with long lines at stores and eager customers ready to upgrade. When Apple does well, it lifts the whole market, because it's such a big player in the S&P 500 and Nasdaq. Its performance can sway the direction of entire indexes, affecting millions of investors. Meanwhile, FedEx's stock rose 2.6% after a strong earnings report, showing solid U.S. deliveries and cost-cutting success. Their ability to deliver more packages efficiently impressed analysts and shareholders alike. Investors love when companies make more money while spending less. It's a sign of smart management and a recipe for long-term growth. Apple's rise was about future expectations, huge iPhone sales, and the promise of innovation keeping the brand at the top of its game. FedEx's was about proven results, running a tight ship, delivering on promises, and showing that operational discipline pays off. These aren't just blips, they're real-world success stories that ripple through the economy and inspire confidence in the market. When companies you use every day are healthy and growing, it signals a strong consumer economy. People buying phones and shipping packages means money is moving, and that's a positive sign for everyone. That's the engine of economic growth. Commerce, innovation, and logistics all working together to keep things moving forward. The stories of Apple and FedEx show how both results and expectations drive the market, shaping the way investors think and act. Their success lifts everyone up, from employees to shareholders and even to the broader economy. It's a sign that the companies powering your daily life are thriving, adapting, and setting the pace for others to follow. And that's good news for all of us, whether you're an investor or just someone who enjoys the benefits of a strong economy. That's how the stock market works. Big names, big moves, and big impacts on our everyday lives. The week's biggest news? The Federal Reserve cut its main interest rate by a quarter point. Why does that matter? Lower rates make it cheaper for businesses and people to borrow. Companies can expand and hire more. You might get a cheaper mortgage or car loan. Lower rates also push investors toward stocks, driving prices higher. The Fed's move was a green light for growth. Investors saw it as a sign to be optimistic. If you have a 401k, this likely boosted your balance. If you're planning a big purchase, borrowing could get easier soon. The Fed's decision was a powerful statement of confidence in the economy. It gave Wall Street and Main Street a reason to feel good. That's why a rate cut matters to you. While big indexes like the S&P 500 hit records, small-cap stocks told a different story. The Russell 2000, which tracks smaller companies, dipped on Friday after hitting a record high Thursday. Small caps are more sensitive to the U.S. economy and interest rates. The Fed's rate cut was great news for them. Cheaper borrowing helps them grow. After a big jump, some investors took profits, causing a dip. Small caps are more volatile than large caps, but their success is a healthy sign for the economy. It shows the recovery is reaching smaller businesses, the backbone of communities. The lesson? Diversify. Don't put all your eggs in one basket. Both big and small companies matter for a strong economy, and small caps breaking records is a good sign for everyone. Not all industries move together. Some sectors soar while others struggle. This week, technology led the pack, rising over 1% on Friday, thanks to companies like Apple. Investors are betting on innovation and future growth. Utilities also performed well. Steady dividends look attractive when rates fall. Energy lagged, dropping over 1% as oil prices fell. Even in a strong market, not everything goes up. Sector performance shows where investors see the future. Tech over traditional energy. If you work in a sector, its performance gives clues about its health. For investors, it's a reminder. Don't concentrate in one area. A balanced portfolio across sectors smooths out the ride. Watch sector trends, they tell the real story. The technology sector's surge is powered by one thing: artificial intelligence, or AI. AI lets computers learn and solve problems, transforming industries right now. This week, optimism about AI sent tech stocks soaring, especially in the Nasdaq. Companies leading in AI, like Oracle and Palantir, saw big gains. Investors are betting on future profits, as AI becomes more integrated into our lives. AI is already changing how we work, travel, and get entertainment. The potential for massive change and profit has Wall Street excited. For you, this could mean new jobs and smarter tools. The AI boom is a bet on the future, and right now, Wall Street is all in. That's why tech is leading the market. The stock market reacts to more than just numbers. It's shaped by global news and politics. This week, progress on a US-China deal over TikTok eased trade tensions, boosting tech stocks. Positive headlines can add billions to the market in hours. News of big mergers like Paramount Skydance eyeing Warner Bros. Created excitement and stock surges. This activity shows business leaders are confident about the future. But not all news was good. A possible US government shutdown still looms, creating uncertainty. A shutdown could disrupt services and slow growth. The lesson? Stay aware of headlines but don't panic. The market is strong, but risks are always on the horizon. Make sure your financial plan can handle bumps in the road. Being informed is your best defense. So, why does a record week on Wall Street matter to you? A rising market signals a healthier economy, creating opportunity for everyone. When S&P 500 companies thrive, they hire, invest, and often give raises. The wealth created on Wall Street can trickle down to Main Street. If you're saving for retirement, this week's rally added real dollars to your future. Lower interest rates make it easier to buy a home, a car, or refinance debt. The revival of small companies means economic strength is spreading. The AI boom points to new industries and jobs ahead. These aren't just financial trends, they shape our lives. The market won't always go up, but this week shows growth is possible. Understanding these changes helps you take control of your financial future. Be informed, be prepared, and make smart choices. When you're financially strong, you're part of the economy's success.